Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Welcome back to ETF Market Insights. I'm Erin Allen with BMO ETFs. Today I'm joined by Bipan Rai, Head of ETF Strategy at BMO ETFs, to discuss his thoughts on current markets and the wild ride that investors have been experiencing on the back of Trump's Liberation Day and the tariff announcements. We've paused our Spring into ETF series to film this video, given that it's so timely and we wanted to address what's going on in the markets, but we will resume our series next week. Just a reminder, we're not providing any investment advice or recommendations. Today is all about information and education. Welcome back to Views from the Desk. I'm Erin Allen with BMO ETFs. Bipan, thank you so much for joining me today.
Thank you for having me, Erin.
It's been a wild ride in the markets this past week, and maybe that's an understatement, but investors are experiencing a lot of increased volatility. We've seen the market correction. Without any news of a material shift in policy around tariffs, how much more room for downside do you think we have?
Yeah, it's the $1 million question right now, or the $1 trillion question, if we want to refer to it in stock market parlance. And unfortunately, it's tough to say. I mean, if you ask me, my intuition is that there's still some degree of meaningful downside from here. And, I think one of the things that's really misplaced when we compare this drawdown to prior drawdowns is that this is a significant macroeconomic shock, right? That's really policy driven at the administration level, or at least from the office of the executive in the United States. We're talking about, the hub of the trade and financial world, of course, the United States, shifting from an environment of low trade barriers to one of extremely high trade barriers. Now, we've all seen that chart of the average effective tariff rate over the last 100 years. And of course, now that these reciprocal tariffs have gone into place, the average effective tariff rate in the U.S. is now north of 20%, which would put it, just above where we were over 100 years ago when Smoot-Hawley went into effect ahead of the Great Depression, but also contextualize it with where we are right now. We're talking about the U.S. having more trade barriers or more restrictiveness to trade relative to countries that are far less liberalized from an economic point of view. And that, of course, includes countries like Algeria, Iran, and Sudan. So there is a significant macroeconomic shock element to this. So, I've been asked frequently, okay, well, when do we start buying? Well, here's the problem, right? So if we are heading into this environment, the inertial move is going to be lower until we get to a place where valuation feels more or less reasonable. And we have seen, if we use the traditional sort of forward price to earnings metric that we used in terms of valuation for equities, for the S&P 500, we've moved from, say, north of 22 into the start of this year towards a level that's closer to 18.8x. But here's the problem, that still feels artificially low given the fact that we haven't really seen any meaningful adjustments to forward earnings since these tariffs were announced. So again, from a valuation perspective, it still feels like we could trend a little bit lower on a go-forward basis. So, besides that, if we are sort of in this let's call it purgatory from the market's perspective, what else could we expect or to really stem the pain and maybe stabilize things from a market lens? There are two things that we're watching for. The first is whether or not we are going to get a Fed put. Now, traditionally, whenever we're down by 20% from the peak, this is usually the point in time which we do get some sort of assurance from the Federal Reserve that they will step in and calm things down. But the problem with that calibration is the fact that if you look at the Fed's mandate, both sides of it, on the employment side, we're still fairly close to full employment, and on the inflation side of it, that's the concern. We're still close to the upper bound of what the Fed would look at. If we look at, say, core PCE, we're close to 3% now. That is a more pressing concern for the Federal Reserve insofar as his mandate is concerned. So then we have to start thinking about, okay, what are the likelihood that maybe the Trump administration backs off from this from these policies? Now, that's what we would call a Trump put. Of course, these could take varying forms with, of course, varying impacts on the market. Of course, the most bullish result would be a complete rescinding of these tariffs. But even if we get something, say, a delay in implementation or potential carve-outs for important trade partners, or even something akin to a lowering of the average effective tariff rate. All of these would be at the very least supportive for a market that maybe consolidates. But again, that is really tough to gauge right now because so far the comments that we've heard from the Trump's White House administration has been sort of full steam ahead on these tariffs. Don't worry about what the market is doing. This is a tough dose of medicine that the markets need to take, and that still is quite concerning.
I love that medicine and patient analogy that he's always using out there. You mentioned in a recent note that you wrote that there's really 4 main corrective channels to watch for. There's markets, which I think we just covered, U.S. households, business sentiment, and congressional republics. So walk us through what you see happening in these channels.
Certainly. So, I mean, again, until we hit or reach that new equilibrium level for valuation when it comes to the S&P 500, we really have to be on the lookout for potentially, the Fed put coming into play or the Trump put. Now, for the Fed put, I kind of addressed that earlier. I think the Fed put, it's still there, but it's probably deeper out of the money relative to prior drawdown. So it might take somewhere close to, say, a 25 or 30% drawdown. Again, not a guarantee, but something that we're certainly going to be watching for if we do get to those levels and the Fed becomes far more concerned when it comes to longer term recessionary risks. But the other element to watch for, and we think the one that there could be some momentum towards in the coming period, is whether or not there's enough pressure being put on the Trump administration to modify these tariffs. Because in their current form, they just don't feel like they can stick around for much longer. And there's really 4 channels to watch for there. I mean, we spoke a little bit about the market, but the way to contextualize what's happening in the market is to understand that this is a wide-scale destruction of value that's going to impact every single element of the U.S. economy and also for the global economy more broadly. But if you take what's happening at the market level and you sort of layer it onto some of the other channels that we're looking at, including household sentiment, which of course tends to shadow what's happening in the equity market more generally. But again, household sentiment has already been tanking. We've seen that in the surveys. We've also, given the fact that we've seen equity markets move lower, we can expect that household sentiment will continue to trend lower as well. Also, business sentiment. Again, the problem with these tariffs is the fact that there's an uncertain nature to them, right? If you tell me that there's going to be a 20% tariff on for the next several years, and I take that away as a guarantee, it's a lot easier to game plan for that. The problem with these tariffs is that, there's a 20% tariff on, say, country X, but there's a good chance that we could be rescinding that over the next coming months. It's a lot harder to game plan for that environment and that backdrop. And and if that's the case, then that means a lot less spending going on by businesses in the real economy, and hiring intentions probably go lower as well. And that does have trickle-on effects through the rest of the economy more broadly. And of course, there's also pressure being generated internally via congressional Republicans. Already we've seen a few Republicans split from the Trump administration when it comes to the issue of these tariffs. And the more and more that equities continue to move lower, and of course, I think this is relevant today, but the more and more that bond yields continue to move higher, I mean, it's going to be trickier for congressional Republicans to continue to, or the ones that are still adhering to Trump's policy, to remain in that camp. So we do think that there's pressure being generated from all 4 of these channels on the Trump team to do something about the current state of affairs when it comes to tariffs.
Okay, a lot of uncertainty. I'd love to get your thoughts on what we're hearing from the Fed and the most recent announcement, what you read from that.
Certainly. So we're recording this on a Tuesday, and that means that by the time that most of our viewers will see this, it'll probably be close to a week after that we got the speech from Chair Powell, the most latest comments, I should say, from Fed Chair Powell as to what the Fed's order of operations is going to be on a go-forward basis. Remember, the Fed has a dual mandate, that is maximum employment and price stability. Right. And often there are periods when those 2 goals come into conflict. And the problem is for the Fed, this is one of those periods, right? Tariffs inherently are inflationary, especially in the near term, right? So what that does is, at a point when core PCE is close to 3%, it means that the Fed has to sort of play or navigate a very tricky environment where employment is at close to full capacity, while at the same time price pressures are drifting higher. Which one do you prioritize in that environment? Well, according to the Fed and according to Chair Powell's comments last week, they're probably going to have to pay greater tribute to the fact that inflationary pressures are still high, because if you let that go, there's a good chance that inflationary expectations, especially at the household level, could continue to migrate higher. And that's something that the Fed is keen to get ahead of. Unfortunately for the market, what that means is that there's not going to be a rush to cut interest rates, at least at this point. we still are expecting the Fed to cut rates later this year. And again, the problem with these tariffs is that if you do introduce or if you do see tariffs migrating or at least leading to higher price pressures, that does put the Fed in a bit of a bind where it has to keep rates restrictive. And another untoward sort of pass-through, a fallout effect from that is the longer that it takes the Fed to ease interest rates or indicate that it's going to support or at least looking towards potentially easing rates, that does also mean downside risk for equities more broadly. So again, a lot going on, and at least given the current nature of this drawdown, it does not feel at this point that the Fed is going to come to the rescue just yet.
All right, thanks for your comments on that. Let's bring it back to portfolio positioning. What's your message to investors? Are we just holding on for dear life? And is there anywhere to really hide, or can you give us some ideas around defensive positioning for our portfolios?
Certainly. I mean, at this environment, I think it definitely does make sense to remain in a defensive stance and posture. And what that means in plain English is that you want to prioritize your income and liquidity. So one thing that we've been sort of focusing on, at least in the near term, is looking more and more closely at cash-like instruments. So ZUCM is the instrument that, of course, we allocated towards in our most recent edition of our quarterly portfolio strategy outlook. That, of course, is the BMO USD Cash Management ETF. That is a particular place that could provide, or of course, will provide that liquidity while at the same time offering a decent yield. We think that is, that is an instrument that could do fairly well in this coming environment. But more further out the curve, what we're really concerned about is the degree of correlation between bonds and equities arising. In that sort of environment, it becomes trickier to navigate, the macro backdrop, and of course, to game plan for what you're going to do with your portfolio on a go-forward basis. In that sort of environment, to us, it makes a lot more sense to look at the alternative sleeve of your portfolio, and maybe allocate a little bit more towards that sleeve. And one of the sort of products that we're looking at more closely is, of course, ZGI, which is the BMO Global Infrastructure Index ETF. Again, we're quite constructive on infrastructure as an asset class going forward, not least because there's going to be a lot of economies that are going to be sort of reassessing what their economic model looks like going forward, and probably looking towards upgrading some of their infrastructure that exists there. Now, it could open the way for infrastructure funds to participate in public-private partnerships. Or if some countries don't have fiscal space, this could result in the spinning off of some important infrastructure assets that could provide some value as well. So again, infrastructure to us makes a lot of sense in that environment. Also, and again, this has been a popular alternative asset to consider for some time now, but we still think there's upside in gold. I mean, our ZGLD has done reasonably well. That's the BMO Gold Bullion ETF. We still think there's upside in this environment. It's at least in the near term where price pressures could push higher, and you could see a greater degree of correlation between instruments like gold and infrastructure in portfolios, that it does mitigate some of the correlation between those assets and some of the other instruments in your portfolio.
Thanks, Bipan, for all your insights and time today. I also wanted to thank our listeners for tuning in. That's all for today. We'll see you next week when our Spring into ETF series continues. Thank you.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.